Revenue recognition. IFRS 15 replaces IAS 18 and is effective for years beginning on or after the 1st of January 2018. The standard was designed to correct some deficiencies with IAS 18 and also some problems with revenue recognition in US GAAP. In US GAAP, there are many different sources of advice on revenue recognition. Some are written by the SEC, some by the FASB, and some are industry-specific. There was the need to create one umbrella framework that could be followed by all entities in the US, irrespective of industry or location. In IAS 18, there was little explicit guidance as to how to deal with bundled components in a discounted package. Therefore, IFRS 15 is structured specifically around this problem. Furthermore, it was often difficult to know whether to apply IAS 11 construction contracts or IAS 18 revenue recognition. IFRS 15 combines both of these standards into the one framework. The framework contains 5 sections. Section 1. Identify contract with a customer. This section sets out the criteria that have to be met for a contract to be in place with a customer. One of the requirements is for there to be a probable flow of funds. As well as giving consideration to credit status of companies, it is worth also considering any political considerations that exist in the country of trade that may restrict the flow of funds. The section also requires the identification of separate contracts or the combination of contracts as appropriate. For example, if 3 separate contracts exist to satisfy a single commercial objective, then these contracts would be combined for the purpose of revenue recognition. This could be the case in the construction of a large asset, where separate contracts exist for each component, such as the hull, the engines, and the interior on a shipping vessel. Contracts could be separated where the payment of one part of the contract is not dependent on the performance of another part. For example, in a contract to construct a wall, payment would not be made upon delivery of bricks, but on the completion of a wall. If the wall was not complete, then it would be very unlikely that payment for the bricks alone would be made. If, however, contracts existed for the supply of bricks for a certain amount, and the construction of a wall for a certain amount, it would be more likely that these contracts would be treated separately. Professional judgment and interaction with the legal function of the business are likely to be required when deciding whether to separate or combine contracts together. Section 2. Identify separate performance obligations. Once separate contracts have been identified, the framework goes on to identify separate performance obligations within each contract. This is important to prevent the front-loading of revenue. If separate performance obligations are not identified, then no revenue would be deferred for recognition in a later accounting period. Consider, for example, a contract for the supply of a software license, installation of the software, ongoing technical support for 2 years, and technical updates for 2 years. There are 4 separate performance obligations, and later on in the framework we will see how to allocate revenue to each component, so that a fair amount of revenue is deferred to later accounting periods in respect of the technical support and technical updates. To be a separate performance obligation, the entity must be able to benefit from the component on its own or with other available resources. For example, if the software required extensive customization in order to work with the client's existing systems, then the client would not be able to benefit from the license on its own. The license and the installation would be grouped into one performance obligation. This part of the framework is the foundation for ensuring that the correct amount of revenue is recognized in the correct accounting period, ensuring that revenue is not front-loaded. Section 3. Determine the transaction price. Before revenue can be allocated to each of the performance obligations, the transaction amount needs to be determined. Fixed revenue is easy to determine. However, the entity must also consider how much variable revenue is to be recognized. The general rule is that if the revenue could be subsequently reversed, it should not be recognized until the chance and size of reversal are minimal. For example, a bonus for completion of a contract on time would not be recognised if the entity has no prior experience of such a contract, since there is no justification for the claim that the contract would be finished on time. However, if similar contracts had been undertaken many times before and completed on time, the entity may recognise the bonus amount of revenue, since the chance of reversal would be minimal. The standard offers lots of practical guidance to assist in making this decision. If financing is provided, then it is important to recognise this fact in the financial statements. Payments in instalments would be discounted back to present value, with the present value being recognised as revenue and the subsequent finance income from applying amortised cost to the trade receivable being measured in finance income over the period of instalments. Refunds to customers must also be considered. Imagine an entity receiving £10 million from a customer, the customer being a retail outlet who will sell the entity's product to the public. The entity provides the customer with a £1 million refund so that the customer's stores can be modified for the product to be displayed in a certain way. In this situation, revenue would be recognised at £9 million, as the entity has not received a distinct product or service from the customer in respect to the £1 million. If the entity had received a distinct product or service whose fair value was £1 million, then revenue of £10 million could be recognised with a separate purchase of £1 million. Section 4. Allocate the transaction price. Now that the separate performance obligations have been identified and the transaction amount determined, the transaction amount can be allocated to each of the performance obligations. The objective here is to ensure a fair allocation and to prevent the front-loading of revenue. Consider, for example, a mobile phone which normally sells for £600, a 2-year airtime contract that normally sells for £200, and a 2-year after-sales service scheme that normally sells for £200. Individually, these components would sell for £1,000, but an entity chooses to sell the bundled package for £700. The accounting question is how much of the £700 to allocate to each part of the bundle. The temptation would be to allocate the whole £700 to the phone, since this is the performance obligation that is satisfied first, and this would result in the whole £700 being recognised immediately. However, the standard requires us to allocate the bundled price in the same ratio as the standalone selling prices. In the example, the £700 would be allocated in the ratio 6:2:2. If the components are not normally sold separately, then the entity could use other observable market data, such as a competitor's normal standalone selling prices. If the observable data is not considered to be comparative to the entity's product, then it could use a cost basis by applying a standard profit margin to the cost of each of the components within the bundled package. An entity will have to consider how it is to perform this allocation and apply professional judgment in doing so. Section 5. Performance conditions satisfied. This part of the framework states that revenue cannot be satisfied until control has passed and the performance obligation has been satisfied. It is interesting to note that in IAS 18, revenue is recognised at the point that risk is transferred, whereas IFRS 15 recognises at the point that control is transferred. For many organisations, risk and control may be transferred at the same point, but for others this may not be the case. The standard gives criteria to decide whether revenue is recognised at a point in time or over time. In this way, it allows the guidance for construction contracts, previously IAS 11, and revenue, previously IAS 18, to be combined into the one framework. There are 3 criteria for recognising revenue over time, and only one of these criteria has to be met. The criteria are: 1. The customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. 2. The entity's performance creates or enhances an asset that the consumer controls as the asset is created or enhanced. 3. The entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. In summary, the new framework is not designed to fundamentally change the way in which revenue is recognised, but instead it is intended to draw together best practice under one framework. However, there are still practical aspects to implementing this standard which must be considered by the entity. It must ensure that IT systems are capable of recognizing the separate components of a bundled package, and it must ensure that there is a standard approach to the treatment of the transaction between legal contracts, sales staff, and the accounting function. Where this is not the case, the accounting function must be fully aware of the differences so that the correct treatment of revenue recognition can be applied. Insurance accounting. The starting point for the development of insurance accounting treatment under IFRS was to deal with many disparate treatments that were being followed in the industry. With this in mind, the development of insurance accounting was to take place in a two-phase project. Phase 1 was the development of IFRS 4 that encouraged standardization whilst allowing existing treatments to be followed. And Stage 2 is the current exposure draft, which is intended to give a much clearer picture of the drivers of profit for a company providing insurance. Essentially, a company works out the present value of the claims to be paid out in relation to the insurance contract, compares this against the present value of the premiums, and identifies the amount of profit to be made on the contract. This contractual service margin is released over the life of the contract. However, there are other things being recorded in the profit and loss account. For example, there could be changes in predicted cash flows associated with the contract. There could be changes in levels of uncertainty and therefore levels of risk adjustments applied to the future cash flows. There could be unwinding of the discount on the present values of relevant contract elements, and there could be an impact from change in the rate of discount to reflect current risks. The exposure draft takes a building blocks approach to provide separate identification of each component of performance, thus giving the user a better understanding of the drivers of profit. It is anticipated that once published, the new standard would have an effective date of 2021. There is concern in the industry given that IFRS 9 is effective from 2018 and will be used to measure the assets backing insurance contracts, and that the new treatment of the insurance liabilities will not take place until 2021. This could create volatility in the intervening period, as IFRS 9 would require certain assets to be measured at fair value through profit and loss, that was not the case under IAS 39. A couple of treatments have been proposed to deal with this period of volatility. Essentially, these would involve either deferring the application of IFRS 9 for relevant entities, or removing the impact of IFRS 9 by reclassifying it from profit and loss to other comprehensive income. These options, referred to as the deferral method and the overlay approach, have not yet been finalised, and neither has the final standard on insurance, so it's worth noting that the proposals above could be subject to change. As it stands, the deferral method could not be applied by all entities. It could be applied by those entities whose predominant activity is the issuance of insurance contracts. This would be determined by ensuring that more than 75% of the liability of the entity arose from insurance contracts rather than other activities. This assessment would take place at the reporting level, meaning that some individual entities within the group may not be able to apply the deferral method, but the group as a whole could. Lease accounting. The standard on lease accounting, IFRS 16, was finally published in January 2016, after many exposure drafts and much debate. The standard will be effective from 2019 and, for many entities, could have a very significant impact. The basic idea is to end off-balance sheet accounting by requiring the entity to capitalise operating leases at the present value of the minimum lease payments, and establish a corresponding liability. Imagine an entity with a significant number of aircraft, vehicles, properties, and other major assets under operating lease. The impact would be significant. The recognition of the liability would be likely to result in a breach of banking covenants, requiring financing to be renegotiated. Key performance metrics would look very different. return on assets would be significantly reduced. EBITDA would be significantly increased, and the performance of expense recognition would alter from straight line to being front-loaded due to larger assets and liabilities at the start of the lease, resulting in large depreciation and interest charges at the start of the lease. From a systems point of view, a large number of assets currently not recorded in some form of asset register would now need to be recorded for the correct calculation of depreciation and interest charge. It is of no surprise that as the standard has been developed, it has met with resistance, which has resulted in some exemptions being available from capitalization of operating leases. For example, if the maximum term of the asset is less than 12 months, or if when new, the asset had an indicative value of less than $5,000. It is also very important to identify which arrangements do contain a lease and which do not. There are in fact many rentals that will not have to be capitalized, as they are in fact rentals and not leases. A lease exists where a customer controls the right to use an identified item, which is when the customer has the exclusive use of the item for a period of time and can decide how to use it. So consider renting a car. You are given a Category G car, which may be a Ford Mondeo or similar. The contract does not include an identified item. Furthermore, whilst you may have exclusive use of the item for a period of the lease, you can't decide how to use it, as a personal rental agreement is likely to restrict you from using the car for any commercial purposes. The standard includes many practical examples of deciding whether or not a lease exists, and therefore it is anticipated that much professional judgment will be required. Deciding which of the entity's arrangements contain leases and which do not will be the first step in determining the impact on the organisation. Calculating and managing the impact will be the second, and collecting the necessary data to generate the accounting entries will be the third. Other recent developments. Other areas of development include consolidation. IFRS 10 sets out a framework of control and gives examples of all the situations in which you may or may not have control, irrespective of holding or not holding a 50% interest in the voting rights. The entity is required to give an annual assessment of which entities to consolidate and which to not. The standard does not provide the answers, but requires you to consider all the facts and circumstances and make a professional judgment. IFRS 11 sees a return to the substance of joint arrangements rather than accounting being driven by the strict legal form. If a company is simply sharing an asset with another company, it should be treated as a jointly controlled asset, even if, for legal purposes, the asset is owned by a separate legal entity. Under IAS 31, this would have required the equity method of accounting rather than treating the asset as a jointly controlled asset. IFRS 11 requires the entity, therefore, to examine the nature of the agreement to see if the right is to the assets and obligation is for the liabilities, or if the right is to a share of the increase in net assets. IFRS 12 requires a list of all entities we have relationships with, and disclosure of the reasons why we have or have not consolidated them. This is intended to give better information about all of the entity's relationships rather than simply those ones that the entity has consolidated. IFRS 13 deals with fair value by giving advice on measuring by reference to observable data for identical instruments, observable data for similar instruments, or fair value modelling. Valuation should be in respect of exit prices and not entry prices, and no consideration of blockage factors should be given, the unit of account being the single underlying instrument. IFRS 10, 11, 12, and 13 had an effective date of 2013. It is also worth noting that the IASB and the FASB have now finished working on the joint collaborative projects. Even where standards have been jointly developed, such as financial instruments, leases, and revenue recognition, there will still be differences in the treatments developed by the IASB and the FASB. These differences, together with historical differences, means that convergence reached approximately 80 to 90%, but significant differences still remain, and with the joint projects at an end, further differences will arise in the future as the boards work on different projects.